Episode 91. 1991 was the year when the Pittsburgh Penguins won their first Stanley Cup, and it's also the year when the individual pension plan, the IPP, was introduced. Beyond MD, episode 91, here we go! My youngest continues to tell me, Dad, why at every moment possible do you find a chance to talk about your Pittsburgh Penguins? The Penguins suck! Get over it! This is coming from somebody who's a bandwagon fan who jumped from the Colorado Avalanche to the Vegas Golden Knights to the Florida Panthers all in the last 3 years. Guys, this is what I put up with. Welcome back to Beyond MD. Today we're going to be talking about IFAs, immediate financing arrangements, which is a strategy that is tied to permanent life insurance. In a nutshell, how it works is you have a properly structured permanent life insurance policy, which can be used as collateral to get a loan from a financial institution, and then that loan can be used to make either corporate or personal investments. That's a very surface level overview. Today we are going to go into the details, and to help us understand this topic, I have the father and son team, Promod and Jeevan Sharma from Tax70 Insurance. Promod and Jeevan go beyond insurance for protection to explore smart uses for tax-efficient wealth growth and multiplying philanthropic impact. Promod, who is an actuary, brings unique historical insight, having worked on all versions of MD Life Plan Universal Life and supporting advisors at MD Management when it was still owned by the Canadian Medical Association. And Jeevan, who is a CFP, ensures that sophisticated strategies like IFAs align effectively with one's broader financial goals. Guys, one thing I have learned is that for these more complicated topics, it can really help to get different perspectives. I have covered permanent life insurance before on the show. Today, we are covering a specific strategy related to permanent life insurance, but along the way, Promod and Jeevan give a good overview of how permanent life insurance works, and I think their take on IFAs is a balanced one with a full discussion of the pros and cons. So guys, with that, please enjoy my conversation with Promod and Jeevan Sharma. Okay, Promod, Jeevan, welcome to Beyond MD. Today we're going to be talking about IFAs, immediate financing arrangements. This is a topic that has come up once before, but today is meant to be a deeper dive. And before we get into the details, I was wondering if the two of you could just give us a 30,000-foot overview, the basics of what an IFA is, and then we can pick away at the details.
Sure. That's a really good spot to start. And thanks for having us as guests. Yeah. And as you know,
it's my pleasure.
I'm one of your regular listeners. So it's great to be here.
I really appreciate it.
Yeah. This side of the way.
Guys, it's the feeling is mutual. And Promod, I know we have had a few really nice conversations leading up to today. And I just wanted to say myself, thank you for listening. Thank you for supporting the show. And thank you for offering feedback along the way, because that's what makes it better for me. So I just wanted to make note of that too.
Thank you. So an IFA is a way to do more with an insurance policy. So you've got your cash value inside an insurance policy, and the policy is earning whatever return it does have. And then an IFA is a way to borrow using that cash surrender value as collateral so that you can invest in things outside the insurance policy. So the same dollars are being used in two different ways, inside the insurance and also outside.
So to utilize an IFA, we have to have a permanent life insurance policy in place. This is something that I did cover in a multi-part series in November 2023. However, I'm a big fan of repetition because there could be a long window of time where that can pass before I reapproach topics. So this might be a good opportunity for us to nail down on some of the basic insurance concepts. So when it comes to a permanent life insurance policy, my understanding is there are two major types, universal life and whole life. In terms of an IFA, does it matter which one we have in place?
Yeah, it's actually very crucial for an IFA to choose typically a whole life policy, and not just a whole life policy, but one that has a high early cash value. So just to explain that point before discussing the differences between whole life and universal life, an IFA is based off of the cash surrender value of a policy. Now, with universal life, the issue that typically arises is the amount of the cash surrender value that can be leveraged in an IFA. If you're investing in something that has good returns, say a mutual fund or uh, perhaps a real estate fund that may be available through a universal life policy. There are limitations on what you can invest in. The issue is with those higher returning products, there's a fairly low percentage of that can actually be accessed. It might be 50%. If you're lucky, maybe 75%. With whole life insurance, regardless of type, it's more like 90 to 100% of the cash value. And the reason for that is with universal life insurance, you have a lot of agency when it comes to choosing what you're investing in. And when you're investing in things like mutual funds, especially as we see these days, there can be very drastic rises and falls. And lenders don't really like that. They would prefer a product that's more predictable in its performance. And that is possible with universal life insurance if you invest in, say, guaranteed interest accounts, things of that nature, but then you're not really earning that much. And the issue is the loan rates on these things are usually, prime plus 1% or some calculation based off of prime. And if your loan rate is 6% and you're earning maybe 3%, 2.5% on these interest accounts, it just doesn't work out mathematically long term. Your loan is going to outstrip the cash value in say 10 or 20 years, and you're going to have to collapse that loan. With whole life, there are guaranteed cash values, which are stipulated in the contract. There's non-guaranteed cash values as well. But everyone who buys that policy is put into the same investment fund that is managed purely by the insurer. And because a bank is more likely, or whatever the lender may be, it could be a credit union as well, they put a lot of trust in the insurance company to invest that singular fund, and as a result, they're more willing to lend a higher percentage against that. Moreover, whole life insurance has something called smoothing, where gains and losses are spread out over a number of years, say 5 to 10 years. I think 5 is more typical, and that means you're not getting these peaks and troughs like you are with a typical portfolio. As you might be in universal life insurance. So it's that predictability and the lack of significant variations in the cash surrender value that make it so appealing to lenders versus universal life.
Thank you for that summary. I want to make sure that people have some basic understanding of the components of the policy, like terms like the cash surrender value and the death benefit. The latter is more obvious. But can you just give us a quick summary of that cash surrender value? What does that term mean? And then we will kind of steer the conversation more into IFAs.
Oh, certainly. I often forget that people are probably not dealing with life insurance on a daily basis.
Oh, no problem.
So the cash surrender value is, there's two components in a permanent policy. There's the fund value, which is really the value of your investments inside of a whole life or universal life product. The cash surrender value is how much you would get if you were to walk away from that policy today. And what people may not think about, and why would you, is if you were to surrender a policy, especially in the early years, you typically don't get back everything that you put in, first of all, and second of all, it's only going to be a portion of that fund value. There are something called surrender charges that can apply. And the reason those are there are because permanent products are intended for long-term planning purposes. So insurers like to reward those that stick with these policies and not necessarily penalize those that cancel, but it helps subsidize those that do stay with those that leave early. And that is a reason that the cash surrender value is typically less than the fund value. Okay. And the reason that banks look at the surrender value is because if they needed to collapse the policy themselves, because you are assigning it as collateral to them, they want to know how much they would actually get out of the policy.
Okay, and now maybe let's talk about how can a policy be structured to allow for, or maybe even optimize, an immediate financing arrangement. I've heard about terms like a pay structure over a certain number of years. I've also heard of a term called the additional deposit option, but I want to leave this more open-ended because I think this is an important point as we start talking about IFAs.
Yeah. So when insurance products, like I'm an actuary, so I used to design insurance products. So they're optimized in different ways. And so for estate planning, you have products that have low cash values in the early years and large cash values later on. And that leads to large death benefits. And with whole life insurance, that was typically how the products would be designed for estate purposes. In the last 2 or 3 years, there have been a number of new products designed that work very well for leveraging. These are designed to have high early cash values. So you might find the cash value in the first year, before it might have been maybe 50 to 60% of the premium being paid. Now it might be more like 70, 80, maybe even 90% of the cash value, of the premium. So that means that these products are optimized for early values. The consequence is, in the long term, they may not do as well as the other products. So you kind of design the products to achieve whatever the goals are. So we have these new whole life policies that have high early cash values, and then you have the premiums that help boost them more. So Jeevan, do you want to talk about the ADO and things?
Sure. So with a permanent product, well, we'll talk about whole life specifically. There is the option, depending on your payment structure. So to just clarify that, with whole life, there are typically 3 ways you can pay the premiums for it. There's something called a 20 pay, a 10 pay, and then a life pay. And with the 10 pay and 20 pay, what those mean is, we'll just take the 10 pay for example. It means that there are 10 guaranteed annual premiums. And the guaranteed part means that after you've paid those 10 annual premiums, the policy is paid up. The insurance company is not going to ask you for more money in the future, which is really important because in the past there have been issues with people paying off their policies in 10 years, but it's non-guaranteed. So then the insurance company comes back maybe 20, 30 years later. And we've unfortunately had to deal with some of these situations. And the insurance company says, unfortunately, your cash value is all gone. There's nothing in your policy to fund more premiums. We're going to need you to pay into this or you basically lose your policy.
Yeah, so you may recall there were, or may not, but there was this thing called vanishing premiums, where interest rates or the credited rates in the policies were high. It might have been 10%, 8%, but the expectation was those same returns would continue forever, and they didn't. And so some of the largest class actions in Canada were against insurance companies who had these kinds of products. And so there were large payouts in settlements to resolve these things. But the industry has learned. And so what they have now are these guaranteed 10 pays, 20 pays. So now you write those 10 checks and there will never be another check that you have to write. So you get that peace of mind. Now, the dividends that you earn, those will still fluctuate, but at least you aren't going to be in a situation. And we had people in their 60s, 70s, where they thought their policy was fine. And we have to tell them that, sorry, your policy is about to lapse because it has no more value. And those weren't policies that we put in place on those clients. But the original advisors basically abandoned those clients. And we were asked by insurance companies, can you please help these clients out? Because what they're expecting is not what's going to happen.
And unfortunately, at the ages they were at, it was really a question of, do you have the money to put into this policy now, or do you want a new policy? And usually in both cases, the answer, like either they didn't have the money to put in, or the premiums for new coverage were simply too high at this point because they had bought, 20, 30 years ago. Their rates probably, in some cases, quintupled or more. In any case, so yes, the industry has learned from those past mistakes and the guaranteed payment periods now exist.
I have a question on this, actually. So let's say that scenario you just described about the policy lapsing because returns were not in line with expectations. Is that scenario still possible if somebody doesn't do their due diligence or whatever have you? Can these scenarios still happen today?
Yeah, it can still happen. It's more likely with universal life insurance where there's so much flexibility. With whole life insurance, it's designed in a different way. What happens is you're in essence overcharged for what you're getting. So the insurance company is collecting more funds than they actually need. And from that, they're able to guarantee cash values. So the guaranteed cash values will equal the face amount at age 100. So you're building up that part. But if it turns out there are more claims because of COVID, for example, or there are more expenses or other things, there's enough in the fund that the insurance company has collected to cover those things. And so you don't really have to worry as much. Now, so the guaranteed cash values are certainly there. They're going to be there regardless. And the other part, it can fluctuate because the insurance companies are investing in the same things as other investors. Mm-hmm. So when markets go down and they have to sell an asset, they realize a loss, as anyone else would. But they're able to spread the losses and the gains over a longer period of time, like say 5 years or 10 years. Mm-hmm. And so when they're doing the calculations of policy dividends, the impact of the fluctuations is lower, and the industry has learned. And so the risk of a policy running out of money is much lower now. When we talk about IFAs, there is a potential risk though, because one of the things that you can get is a tax deduction on a portion of the premium. Now, to get that tax deduction, a premium must be payable in the year. So normally in typical cases, we will see doctors who want to write the 10 checks or maybe the 20 checks and be done with it. For an immediate financing arrangement, it's more likely that they would have a life pay structure. So there are base premiums due every year, but they would put in extra money through these additional deposit options in the first 10 years so that then the dividends in the policy would likely cover the future premiums in later years.
I gotcha. That makes sense to me somewhat, and I think through repetition it'll make more sense over time. But okay,
you don't want us to repeat it. I hope
it's a lot to take in.
Yeah. No worries. So I would love to move on to just a quick scenario of who may want to set up a permanent life insurance policy with an IFA. Can you give me a scenario of who may benefit from something like this?
Okay. Well, the starting point would be having a reason for permanent life insurance.
Yeah.
And so that would relate in many cases to dealing with estate planning, that ultimately there will be a big tax bill that needs to be paid. So insurance can help with that. Now, the way taxation works in a corporation, as you earn more than $50,000 of passive investment income, you start exposing more of your active business income to a higher tax rate. If you take some of those retained earnings in a corporation and put them in life insurance, then you eliminate that particular tax. So you can do that. So there are a few reasons why life insurance may be worthwhile. So you do need to have that rationale first of all. But then what happens is, and these days we see most people would get whole life insurance because the tax rules for insurance changed Jan 1st, 2017. Whole life works better under the new rules than universal life does. So they'll get the whole life policies, they'll pay the 10 premiums, and then they're basically done. So for some doctors, that's fine. They don't want the hassle of anything else. But there'll be other ones saying, well, okay, I understand the reason for insurance and I'm getting it, but I don't want my money tied up in it because I would like to invest in real estate or other things. So in essence, you can add an immediate financing arrangement to that policy. And now you are borrowing against the cash value and investing in the things you would normally want to invest in. And because you're taking an investment loan, the loan interest can be tax deductible. And also because the lender is a restricted financial institution and says you must have insurance as collateral for us to approve your loan, then a portion of the premium can also be tax deductible. So the end result is you've got all the protection and the rationale for that, but you've also got access to your funds to invest in other ways. So this needs to be someone who is comfortable with borrowing to invest as one of the requirements.
Before we dive into the details, I just wanted to ask, when setting up an immediate financing arrangement, is that something that has to be set up when the policy is set up, or is that something that could be tacked on later on should your appetite for investing and borrowing to invest change?
So that's a very good question. And the short answer is it can be tacked on later. However, it's generally a good idea to do everything up front. And the reason for that depends, or it's based off of the goal that a person has for their insurance. Now, if they're going in knowing that they are comfortable with leveraging, that they have investments they would like to pursue other than insurance, but also want the insurance, it's fairly clear what kind of product they want. They want something with a high early cash value. The later death benefit and cash value maybe aren't as important. And from the outset, that's the sort of the viewpoint they have. If it's a client where they're being more speculative, where maybe they want this opportunity but they're not sure, it's a little bit harder to say because the cost, if you want to call it that, of getting a high early cash value product is that typically it won't grow as much as something that has lower early cash values, but then accrues to greater values later, because there's different structures to whole life. And usually these products that have, and sometimes the cash values early are insanely low. Like you put in $100,000, your cash surrender value is like 2,000. Like it's insanely low. However, if you look out 20, 30 years, it has maybe 50% more, 100% more of death benefit versus a product that has a high early cash value. So it just has to do with internal structuring and things of that nature. So if a client is being speculative, there's nothing wrong with getting a product that's more suited towards an IFA. However, they do need to be aware that there is a opportunity cost, in a sense, of doing so.
I'd like to take a minute to talk about a company that I've been following for a few years now. I initially met them on this very podcast and was taken by their story and passion to make life better for doctors. Introducing Aria Health, the groundbreaking electronic health records company that's redefining the way doctors practice medicine. Aria Health is all about putting doctors back in the driver's seat, in control of your destiny to become the doctor you've always aspired to be. Aria Health is not your typical EHR company. They're all about keeping the focus where it belongs, on you and your patients. They want to empower you to be caring, present, efficient, and powerful in your medical practice, without the burden of endless note-taking and paperwork. Join the Aria Health community of doctors who are already taking back their lives and practicing medicine the way they were meant to, free of corporate shackles, one patient at a time. But that's not all. Your time is precious and you want to get back to what truly matters. Aria's unique promise is to get you up and running as a new clinic in less than 30 days. And if you're thinking about integrations or migrations, don't worry. Aria can get you set up in less than 2 months so you can seamlessly transition without missing a beat. What sets Aria Health apart is their unwavering commitment to helping doctors thrive and making doctors the heroes of the healthcare story. They leverage the power of artificial intelligence, handling complex data ingestion and automating workflows so you can focus on patient care, not paperwork. And I've seen this in action myself. Visit ariaehr.com, that's ARYAEHR.com, and discover how Aria can empower you to take charge of your medical practice. You can use a special code BeyondMD to get your first month for free. Let's say that somebody does set up a permanent life insurance policy. Let's say it's a whole life policy, and they decide to structure it so that the cash value will be higher earlier on. And then they say, well, I want to pursue this opportunity of an immediate financing arrangement, an IFA. They're going to be using the policy as collateral for a loan. The first question I have is, what's being used as collateral? Is it the cash surrender value or the premiums?
Yeah, well, it's the collateral is the entire insurance policy. But within that, it's not really the premiums that matter. It's the cash surrender value that's really key, because what the lender wants is security. And if you have assigned the policy to the lender and for whatever reason you are not paying the interest on a monthly basis, they could, in an extreme case, cancel the policy and they would get all their money back. Now, it would not be good for you because you no longer have the insurance, and there may also be tax because the insurance policy was canceled. But it's the cash surrender value that gives them full comfort that they are secure. And as a result, they can also provide attractive loan rates because they have this collateral that's so good.
In terms of how much can be pulled out from the policy? Pramod, you had mentioned maybe up to 70, 80, 90%. Like, what is the upper limit of what can be taken out for investment purposes?
Well, what we typically see is so for these policies, the minimum premium needs to be $50,000 a year for 10 years. Mm-hmm. Or maybe 100,000 a year for 10 years, because the lenders generally will not accept a loan that's smaller than those amounts. Mm-hmm. So if we look at, just to keep the math simple, the doctor writes a check for $100,000. The cash value in one we had recently was what, 83,000?
83, exactly.
Yeah. So then, but the doctor wanted to borrow the full 100,000 back. So if they just wanted the 83,000, then there would be no additional collateral required. But if they wanted the full premium back, then they needed $17,000 of additional collateral. And in this case, they would need additional collateral. It was maybe 4 years?
4 years.
Yes. And so what they decided they would do is just buy a 4-year GIC from the lender. And I think the total amount was maybe 40,000.
Yeah.
Yeah. And so that way they're set. They don't have to pledge any other collateral for that. Now, others may say, well, I don't really want to borrow back the full premium. I'm happy with the 83,000 in this case, and they would not have additional collateral. So each case is different, but what seems to appeal most to people is I wrote a check for $100,000 to the insurance company. I borrowed back $100,000 from the lender. And so I am now investing in the things I would like to invest in outside the insurance.
Okay, what type of lenders are people usually using? Is it a big six bank or another lender?
Well, there's a range. So the first place to go would be to your own bank and talk to your banker. Now, that particular branch probably cannot do cash surrender value lending, but that institution probably can. We hear that Scotia and BMO seem to be more active in this space. More recently, we've heard that TD is getting quite active also. But there are also specialized lenders. And when you're going to your bank, they might require a larger loan. So they might require $1 million loan, $2.5 million. They have different requirements.
And when we say that, that's over a 10-year period. So it would be borrowing that $100K for 10 years. Say.
Yeah, but they have an idea in mind of how much they want. There are other lenders that will start at $50,000. So at that end, you've got Manulife Bank. You've got Duca Credit Union. At $100,000, you've got EQ Bank. And there are also lenders for people who may not have very good credit, but they charge higher rates. So there's a range of lenders, but we would suggest talk to your current lender first. And if they can do something for you, that may be the best terms and best rates, depending on the amount being borrowed. If not, we have these other lenders available that are very specialized in this kind of lending.
Now, we're using the permanent life insurance policy as collateral for a loan here. The loans that are taken, are they typically personal loans or corporate loans?
So it depends on the situation. To get the most deductibility from the strategy, it is best to have the same entity taking the loan as owns the insurance policy. So if someone is, say, reinvesting in their business and they want to own the policy inside of their business, which may or may not be recommended, because there is a case to be made for owning an IFA outside of an OpCo, simply because you may want to sell the OpCo at some point, and it's very, very messy to get an insurance policy out, very costly. It's really not worth it. As a result, it's typically held in a holdco. But let's say for whatever reason they wanted to hold it in an OpCo and they wanted to reinvest in their business, they could do an IFA, take the money from the bank, reinvest it in their business, and because they're investing it in such a way where it's generating traceable, taxable income, they could get to deductibility on the premium as well as on the loan interest. In a lot of cases, though, it'll be a holdco owning the policy and then a personal borrower. And in situations like that, what happens is there may be a guarantee fee that's payable from the personal borrower to their corporation. And the reason for that is that there may be a benefit given by the lender to the corporation where the corporation's getting a better loan rate than the individual might were they to take the loan on their own. Now, this is something that isn't, there's really no stipulated rate, and it depends on the accountant involved. Some will say that no guarantee fee is required. Some will say it's 1, some will say it's 2. And there's nothing really, quote unquote, written in stone from CRA regarding this. It's really more of a best practices sort of viewpoint. But in a lot of cases, I guess it's sort of a split, isn't it?
Yeah, the cleanest is another way to look at it is, and when we talk about holdco, we also mean medical professional corporation. That can also be the owner.
Yeah.
But the way to look at it is, where is the money for the insurance premiums? And often that's inside a corporation.
Right.
And then where are the highest tax rates? And that might be inside the corporation if you're looking at passive income at 50.17% in Ontario, or it might be personally where it could be 53.53%. And so it's a matter of figuring out these things. The product ends up being the same. So it's more the optimization. And this is where involving the accountant can be important to figure out, where would this make the most sense?
I do want to pick away at this guarantee fee a little bit more, but before I do, I just want to know, let's say the policy is used as collateral for a loan from a financial institution. What types of interest rates would we be looking at for this loan, assuming that the borrower has a good credit history?
Well, the rates are based on prime. So we've heard of situations where the rate is actually a bit below prime, depending on the borrower, and other cases where it's above prime. So as a default, you might want to look at, say, prime plus 1%. As something to think about, but it could be like higher, it could be lower.
Now, what I've heard just through conversation with a few people in this space is that, let's say you get a loan from a financial institution using your policy as collateral. If the interest rate that you get on that loan is a good rate, and let's say it's better than a rate you would have gotten for a loan otherwise outside of this policy, and let's say you're taking this loan personally, then what I've been told is maybe there's a reason to be a little bit cautious in case there is an audit. And let's say the CRA says, well, this is a personal benefit that you're receiving. You're getting a much better rate on the loan than you would have otherwise. Now, there may be a case to be made that there could be tax owing on that rate differential. Is that where the guarantee fee comes in to kind of offset that risk?
That's exactly right. So it's to offset benefit, or to prevent that benefit from becoming a taxable shareholder benefit.
Have you seen audits like this happening based on the scenario that I described?
We have not seen audits ourselves because, we're not accountants, so it would be more for them to see.
Yeah.
There are also the other extreme where the loan rate is really based on, it's largely based on the cash surrender value of the policy. And so in some cases, you could argue the loan rate is going to be the same whether you borrow personally or whether you borrow corporately. And so maybe the guarantee fee is much smaller. Maybe there isn't even one. But it's one of those areas where there's all this uncertainty. And the more aggressive the interpretations are, the more risk there could be of an audit. So we generally hear of rates between 0.5% and 2% being used as the guarantee fee, but it's really up to the accountant to figure out what makes sense for that particular client, because there is this ambiguity.
So let's say we are taking out loans using the policy as collateral. Does this impact the cash surrender value or death benefit in any way? That's one thing I'm not too clear on.
Well, the policy will grow the very same way as it would if there were no loan. So the insurance company, in a sense, is not involved in the loan. The policy is just growing the same way that it normally would. Now, the loan needs to be repaid one day, and typically that's at death and from the death benefit. So then the death benefit would be reduced by the death benefit would pay off the loan, and what's remaining would then go to the corporation. So it is reduced in that sense.
Last thing on the loan is the mechanism of using the policy as collateral versus just borrowing from the policy itself. What's the main difference that we need to know there?
Yeah, so the big difference there is policy loans do affect policy value. So they will reduce the cash value. They can, or generally they will reduce the death benefit as well, provided based off of how large the policy is and a few other factors. And it's also there's something called the ACB inside of inside of an insurance policy, and the policy loan is tax-free up to the ACB, but any amounts above that are typically taxable. Now, the ACB is usually, generally 20 to 30% of the cash surrender value in the early years, but it fluctuates. So in the very, first few years, it's low, then it goes up, and then it drops again, sort of a bell curve in that sense. And the issue there is because it's the formula used to determine it makes it so it's kind of, it has that strange progression over time. It's hard to actually have a strategy that uses it, first of all. And second of all, it's easy to run into taxation issues because you can exceed that ACB threshold pretty easily in the later years.
And that's the adjusted cost basis.
Yeah. Just to clarify that, because most investors think of an adjusted cost base, which is also called ACB. The insurance adjusted cost basis is actually quite different. It's a complicated formula based on the total premiums you've paid minus the cumulative net cost of your insurance. So it's quite involved. But as Jeevan is saying, it does have this pattern where eventually the entire loan would be taxable.
That's right.
So if you've come across people talking about infinite banking as a strategy, in the US, it works because you can take policy loans. In Canada, it doesn't work that way because policy loans don't make a lot of sense, except maybe in the early policy years.
I want to really now pick away at if somebody is to pursue an IFA through a permanent life insurance policy, how this process can be tax efficient. Because I have had colleagues reach out to me and they've told me that they're using this approach. But let me just paint one scenario and then you can help me understand how this can be tax efficient. So let's say we have the permanent life insurance policy, we use it as collateral for a loan, and we implement this IFA strategy. And let's say that that loan is taken and used for different types of personal investments, because let's say the individual is at the highest marginal rate of 53.5%. The investments that are made personally using the loan, is the interest on the loan tax deductible? That's my first question. And then beyond the interest on the loan, is there anything else that is tax deductible in this process?
Yeah. So the interest is tax deductible depending on what the investments are. So you're getting the tax deductions because the idea is you're generating taxable income. So if you're investing in things that are only going to generate capital gains decades later, then that could be problematic. But if you're investing in real estate or other things where there's turnover, there's like tax being generated, then that would likely be acceptable. Again, this becomes one of those questions for an accountant to make sure that what's being done does satisfy the requirements for our interest deductibility. For the collateral insurance deductibility, there are some criteria. First of all, the interest has to be deductible. The loan has to be from a restricted financial institution, which is generally like a bank or a credit union. So it can't be from like a neighbor. And I think there's one other criteria there.
The policy had to be assigned to the lender as a requirement for the loan. That would be the third one. Yeah.
So those are the criteria. And then the amount you can deduct is not the full premium. So even though you're borrowing the full cash value, say, you can't deduct the full premium. You can only deduct a portion, the portion of the loan relative to the total death benefit. And you multiply that by the lower of the premium paid in the year, which is the reason for a life pay structure rather than a 10 pay structure. So the lower of the premium paid and the net cost of pure insurance. So it ends up being fairly complicated, and the tax savings on the collateral insurance deduction may not be all that material. And that's why in some cases, the doctors will say, I would just give me a straight 10 pay structure. I don't want to worry about any possible premiums in the future. Yes, I understand I won't get this collateral insurance deduction after the first 10 years, but it's not really that big a deal in the scheme of things.
Yeah, so just to give a brief summary. So the big deduction would be on the interest. There would be a smaller potential deduction based off of the premium paid, but that's usually just a small percentage of the interest deduction. And then when we're talking about tax efficiency, there's also it's important to consider the fact that any funds invested in a permanent life insurance policy are tax deferred, and that deferral can last for life provided that the policy is correctly structured.
Is there a personal tax bracket threshold where this strategy becomes much more effective? Or is it more a matter of comparing your personal tax bracket rate to, let's say, whatever passive income you're generating inside the corporation? This might not be a super relevant question, but it's on my mind. Like, who as an individual from a tax perspective or a tax bracket perspective would truly benefit from this?
So that's a very good question. And my answer would be that in most cases, a person would probably need to be in the top marginal tax bracket for this sort of strategy to even be possible, simply because of the amount of deposit required. And if they do have a corporation, that corporation is probably generating quite a lot of money in that situation. So then it really just becomes a case of, well, as Pramod said, it's a sort of an accountant's question of where is the tax highest, where is it occurring the most frequently? Because it does also depend on what holdings are inside of that holdco. If it's vehicles that only generate capital gains, then it may be less important because you're not getting taxed on an annual basis. If it's more fixed income, there could be a stronger case. But your question was, is there a tax bracket where it doesn't make sense versus does make sense? It's hard to say. But generally speaking, if we're looking at somebody who doesn't have a corporation, they're only earning personal income, it would likely be somebody in the personal or in the highest tax bracket.
Yeah. The way I would answer that, I would say, first of all, great question, great answer. And then I'll give my answer too. That rules of thumb are problematic because they don't apply to a particular situation. Mm-hmm. So what we do is we just create the different scenarios. Okay, so what happens if you do this personally? What happens if you do this corporately? And that way we can actually see what the implications are, and from that get a better idea of what might be the best solution. So we don't need to have a general answer because we can get an actual answer.
Now, some would say that using the policy as collateral for a personal loan, investing it personally, that is essentially a bit of a loophole. And my question is this something that could be shut down? It might be something that's very difficult to answer or forecast, but I would love your perspectives on it.
Well, there are always issues or potential issues when you're doing any kind of leveraging. But if you look at what's taking place, we have something that is really quite secure. The whole concept of having a collateral insurance deduction from the federal government says that insurance can be used as collateral for loans, and you actually can get some tax savings from it. The whole idea of borrowing to invest, that's been a pretty well-established practice. We're dealing with independent lenders like banks, etc. So you have all these parties that are separate. There was an earlier strategy some years ago called 10-8 leveraging. I don't know if you've come across that.
No, I haven't.
But in that, what happened, that was using universal life insurance. In that, what was happening is the insurance company was also the lender, and the spread between what you earned in your policy and what the loan was at was guaranteed to be 2%. And so ultimately, what was the government decided in 2013, that needed to be shut down because it was working too well. So the industry learned from that. And so now what happens is there are like situations where maybe the insurance is from RBC Insurance, but the loan won't even be from RBC, or it's Manulife Bank versus, but not Manulife Insurance. So you can, take steps to prevent risks by having separate parties. So you've got your insurance from one party, you've got your loan from another party, you've got your accountant giving opinions on what they think suitable investments are. So when you look at all of these aspects, it looks like it should be pretty safe. But again, there is that risk. And that's why for some people, maybe most people, it's better just to get normal life insurance without the leveraging aspects.
And if somebody was to take part in an IFA, are there any additional fees to implementing this process?
Yes, there are a range of different fees, and this is why it's good to go to different lenders to see what they are. But there can be a fee for the setup or the application. There can be a fee for the annual advance that is being provided. So there are fees like that, and they vary by lender, but that's something important to consider so that the right decision can be made. But generally what we see is that the fees are relatively small in comparison to the benefits. But there could also be more accounting fees because now your accountant is doing more work.
We talked about repaying the loan. One strategy would be to have the death benefit pay back the loan, and whatever's left over can go to the next generation. Are there any other ways to pay off the loan?
Yeah, another way would be to simply sell the assets that came from the loan proceeds, or to use other funds. So the loan can be repaid anytime as long as funds are provided. Perhaps the most tax optimal, as long as the tax deductions are needed for life, is to have the death benefit repay the loan, because then nothing has to be sold in order to do that. But there is that flexibility.
So as we kind of get to the end, I know we talked about who might benefit from this, but guys, because this topic is complex and I want to make sure that my audience has a basic list of questions to ask when these scenarios do come up, are you able to provide just a brief checklist of basic points that should be fulfilled before somebody pursues permanent life and before somebody pursues an IFA? I would love to really drill this home.
Right. So there are definitely a few items to look out for there. The first would be, and this is really the most important from a compliance standpoint, is there a need for long-term insurance coverage, a permanent insurance need? And for almost everybody who would have the assets available for an IFA, the answer is typically yes. Usually they have significant assets that are going to result in a significant tax bill when they pass away, or if they're married when they and their spouse have passed away. It could be a situation where they have philanthropic intent that they want to address when they've passed away. So there are usually situations where long-term insurance does make sense. That's not to say it does in every case, though. So that would be the first thing to discuss, and that's something that we help clients explore, something that they can also simply think about. The next would be thinking over what their cash flow looks like. Now, even if they're earning a lot of money, there's a good chance that they're using all of it, or it's been allocated in a certain way. So if there's a tight or an unstable cash flow, that could make it difficult to use this policy, because with whole life insurance, and this is a big difference between whole life and universal life, where universal life can actually come out ahead. There's no real premium flexibility in the early years. And we talked about overfunding, a life pay whole life policy so that you stop paying premiums by, say, year 11 and you have the dividends paid off after. But prior to those 10 premiums being made, whether it's a guaranteed 10 pay, non-guaranteed 10 pay with the premium offset, which is what that strategy I just described was, if you can't make one of those premiums, there aren't many good ways of actually keeping the policy afloat while still having it perform the way you intended. What could happen is that the insurance company will say, okay, you have X dollars of cash value. You can't pay any more premiums. What we'll do is we'll look at how much permanent insurance that's completely paid up you can get right now with that cash value. And with high early cash value products, that may end up being okay. But again, you've consumed all your cash value. There, you can no longer do an IFA with that policy, or you may have to cancel and have all those funds come out. Whereas with UL, you can choose what you want to do. You can have a much higher premium one year, a much lower premium the next. There are some tax laws that dictate how much variation you can really have, but you're not locked into paying, say, $50,000 a year for 10 years, and you must pay $50,000 a year. So cash flow is a big consideration there. Risk tolerance is very important to consider. If there's insufficient taxable income to use the deductions, that's another aspect, because that can severely hamper how effective the policy or the strategy is. There's also the risk of getting poor investment returns. So it's important to know what someone would be investing into. Is that something that's stable or highly speculative? And then the last one is there a plan to have good documentation? Is there a commitment to going through perhaps the annual review process, or is that something that wouldn't be palatable to the client? So I would say those are the major points. The big three probably being the first three I mentioned, which were: is there an insurance need long term? Is cash flow available in a way that can fund the policy predictably? And is the risk tolerance there?
Somebody would typically set up an IFA. What I've gotten from this conversation is if somebody has a need for insurance, but somebody doesn't want all those funds to be tied up and they want to pull money out and invest the money and they're comfortable borrowing to invest. But let's say somebody does not have those needs and they say, I want a permanent life insurance policy exclusively for estate planning purposes.
Right.
That for me would be a reason to probably avoid an IFA. But what are some other reasons to maybe not go down this route?
Yeah, I think you've identified a pretty good situation. And what we see with most people is that they're more concerned about the estate issues and possibly supplementing their retirement income. So they have more flexibility, whether they're using RRSPs or IPPs or whatever. And so we typically have products that are designed to have higher long-term cash values. And they could be used to supplement retirement income if that was a goal. That's called a corporate insured retirement plan. And then they also have the large death benefit so that they can have more to pay off the taxes, more to go to their heirs, etc. So that's a very typical type of scenario. And many are satisfied with that. I think you had a recent podcast where it was about returns versus hassle. And if you just get insurance where it's simple, you pay your 10 premiums, it's whole life, you don't have to invest anything, you've made part of your life very straightforward. Now, if you want to do more things, then an IFA is a way that you can do more. But how much more are you getting from it? That's something to consider. But if you do like borrowing to invest, et cetera, here's a way that you can reduce the cash flow that you need for the insurance and still invest. So there can be some very good advantages.
Promod, I have to say, you are a very astute listener to the pod. You picked up on, or you remember that point about returns versus hassle, which was an interesting concept. I appreciate that. Are there any risks related to an IFA that we have not talked about today that are worth knowing about?
I think a lot of those risks are ones that would be inherent with any kind of loan, right? You have the interest rate risk, you have the risk of terms changing, but ones that are specific to insurance, in terms of it being leveraged, I don't think any really come to mind other than the dividends being far below what's expected. Now, most insurers simply will not illustrate IFAs at anything above their current dividend scale minus 1%. So there's a bit of conservatism built in already there. And we ourselves always illustrate at scale minus 1%, except in some very specific circumstances. But with IFAs and with any leveraged sort of scenario, we always do scale minus 1%. Okay. But that's the one aspect where there could be issues specific to insurance. However, that's generally addressed by the way insurers choose to manage their whole life investment block, and also addressed through the smoothing to a large degree as well.
Yeah, and also it would be important to have good documentation. So when you're borrowing the money, to be able to trace that to the investments made with it, rather than just commingling these borrow funds with other funds. There needs to be coordination with the accountant. There is some work to do on an annual basis. The lenders want to see how the policy has been performing. So some people may not like doing all of those things that take this extra diligence and care and documentation. But yeah, I think Jeevan has covered the main points.
Right. And the final one I could think of is, if cash flow suddenly becomes unexpectedly restricted, that would also be an issue. But that could likely be an issue with any loan as well. Though in this case, you have to think about the premium as well as the loan interest instead of just the interest.
Yeah. So an advantage that doctors have is that income tends to be relatively stable. So if you look at, say, a business owner and you look at what happened in COVID, there were some who were quite affected. But there are other professions where the income tends to be more stable. So the risk ends up being lower of not being able to cover the premiums or use the tax deductions,
Right.
et cetera.
Okay. And the last thing, Promod, Jeevan, where can people learn about your work and what you're doing?
Probably by visiting our website, taxevity.com, taxevity.com. And you might have a link in your show notes. I don't know.
Yeah. No, well, of course we'll have that. I have to thank you guys both for coming on and giving a very thorough overview of IFAs, which are daunting, certainly, I think, misunderstood. We hear the term being thrown around. I wanted to thank you guys for taking the time to come on and educate myself and my audience.
Okay. We appreciate the opportunity. And we thank you for the thoughtful questions that you've been asking.
Yeah, thank you very much.
Oh, guys, it's a pleasure. For me, I say that any day where I have an opportunity to use my curiosity, it's a good day. So I learned a lot today, and I thanks again for your time.
Our pleasure.
Our pleasure.
I'm reading a really interesting book right now called Range by David Epstein, and it's about why generalists triumph in a specialized world. Towards the end of the book, there's a really interesting quote. It's about scientist Oliver Smithies and when he's tinkering around one day in the 50s in his lab in Toronto, and he starts to play around with starch, and this is one of the discoveries that is a big step forward in making gel electrophoresis a reality. And on one of those days of tinkering, Oliver Smithies says that one needs to let the brain think about something different from its daily work. And this is exactly why I do Beyond MD. This is why I personally find it so gratifying and why I like to dive into these topics. I love to learn and I love to share it with you. Thank you for joining me on my journey. I hope you found today's episode useful, and we'll see you in a few weeks' time. Stay well, stay savvy.